Today, a tale of two central banks. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the Dow closed higher on Wednesday after swinging between gains and losses as investors digested the Federal Reserve's December meeting minutes, which signalled higher for longer rates, and also data showing a tight labour market that stoked fears of a wage-driven pickup in inflation. Federal Reserve officials last month affirmed their resolve to bring down inflation and, in an unusually blunt warning to investors, cautioned against underestimating their will to keep interest rates high for some time. Fed members favoured a restrictive policy stance for a sustained period until inflation was on a sustained downward path to 2%, which was likely to take some time, the Fed's December meeting minutes showed. Going into the meeting, markets were pricing in rate cuts in the second half of 2023, but the tone of the minutes of the Federal Open Market Committee's December 13th-14th meeting suggested frustration that this was undermining the central bank's efforts to bring price pressures under control. Fed officials noted that an unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's efforts to restore price stability, according to the minutes. US stocks paired gains following the report, while the Fed policy-sensitive 2-year Treasury yield rose and the dollar remained lower. Pricing in financial futures continues to show investors betting the Fed will begin lowering rates before the end of 2023, despite what they said. The Dow Jones Industrial Average climbed 0.4%, the Nasdaq Composite was 0.69% higher, while the S&P 500 closed 0.74% higher. The market is like a kid asking for ice cream. The parents say no, but the markets keep asking because the parents have caved in the past, said Burns McKinney, portfolio manager at NFJ Investment Group. The market still thinks it's going to get ice cream, just not as soon as they thought before. McKinney pointed to the minutes for evidence of Fed officials' concern that an unwarranted easing of financial conditions would complicate their efforts to fight inflation. A big concern of their messaging here is that the market is pricing in cuts by the second half of this year, said Michael Ferrari, chief US economist at JP Chase. With inflation too high, officials realize that the risk of over-tightening is just something that they have to swallow and stomach, he said. US central bankers raised the benchmark lending rate by 0.5 percentage point at their gathering, slowing down after an aggressive string of 4 straight 75 basis point increases, and officials also issued fresh forecasts that showed a hawkish tilt, with more hikes projected into 2023 than investors expected. There were no Fed officials that forecast rate cuts this year. They don't see light at the end of the tunnel yet with inflation, said Derek Tang, an economist at LH Meyer in Washington. They're so alert of financial easing that's unwarranted that the scale should tilt to staying with 50 basis points in February. That'll drive the message home, he said. The minutes showed Fed officials' intent on lowering inflation back towards the 2% target at the risk of rising unemployment and slower growth. The record also highlighted the Fed's rate projections being notably above market expectations for the path of policy, which several officials argued would underscore the FOMC's determination to lower inflation to its 2% goal. The Fed's move last month extended its most aggressive tightening cycle since the 1980s. Starting from near zero in March, officials lifted their benchmark lending rate through successive meetings to a target range of 4.25 to 4.5%. That's the highest since 2007, and Chair Jerome Powell said at a post-meeting press conference that the committee has more work to do, explaining that how high rates ultimately rise and how long the Fed holds them there was more important than the pace at which officials reach that destination. He also described the labour market as out of balance and extremely tight, and warned that restoring stable prices is likely to require some softening in job market conditions. But also on Wednesday, Minneapolis Fed President Neil Kashari stressed the need for continued rate hikes, setting out his own forecast that the policy rate should initially pause at 5.4%. The Fed minutes are a good reminder for investors to expect rates to remain high throughout all of 2023. Amid a persistently strong job market, it makes sense that fighting inflation remains the name of the game for the Fed, said Mike Lohengrat, head of model portfolio construction at Morgan Stanley. Bottom line is that even though we flipped the calendar, the market headwinds from last year remain. The US Labour Department's latest job openings and labour turnover survey, JOLTS report, a measure of job demand, showed job openings in November fell less than expected to about 10.5 million, compared with expectations of 10 million. The JOLTS report was very strong, Jeffries said in the note, warning that without a substantial reduction in labour demand, the Fed will not be comfortable pausing, let alone cutting rates. And US payrolls are projected to have risen by a still solid 200,000 in December, ahead of the release of the monthly employment report on Friday. And quarterly economic estimates updated by Fed officials last month showed rates rising to 5.1% this year, according to their meeting projection, up from 4.6% in the prior round of forecasts in September. The Fed's staff said that the possibility of recession was a plausible alternative to the baseline outlook for slow economic growth of 2023. The sluggish growth in real private domestic spending expected over the next year, a subdued global economic outlook, and persistently tight financial conditions were seen as tilting the risks to the downside around the baseline projection for real economic activity, they said. And 17 of 19 officials projected rates at or above 5.1% this year. By comparison, not a single Fed official in September had forecasts above 5% in 2023. Policymakers will next meet on January the 31st and February the 1st. And ahead of Wednesday's minutes, futures markets were pricing in an increase of at least a quarter percentage point. The minute said officials will decide meeting by meeting on rates. The more restrictive policy stance is expected to lift the unemployment rate to 4.6% by the end of the year, compared with 3.7% seen in November, the Fed's latest projection showed, and their forecast also showed a higher median estimate for core inflation of 3.5% in 2023, about a percentage point lower than the 4.7% November reading of the core personal consumption expenditures price index. So the story from the US is tightening and removing liquidity from the markets. But in comparison, over in China, China's central bank reiterated it will implement a targeted and prudent monetary policy in 2023 and will provide support to domestic demand. The People's Bank of China said that it will comprehensively use multiple monetary policy tools and keep liquidity reasonably ample. The remarks in a statement on Wednesday followed the PBOC's annual work conference. The PBOC is expected to keep monetary policy loose for at least the next few months, with the economy still suffering disruption from widespread virus infections following the nation's abrupt exit from its COVID-0 stance. Monetary stimulus in 2023 will be at least as strong as last year, and policy will be focused on supporting domestic demand, officials said recently. The PBOC is also viewed as having more space for easing this year, given expectations for the Federal Reserve to conclude its interest rate hikes, providing support for the yuan against the dollar. Speculation is growing for an upcoming reduction in China's 5-year loan prime rate, and the lowering of that reference rate for mortgage rates may help stimulate housing demand. And the PBOC added that it will provide support for the recovery and expansion of consumption and for major infrastructure projects, and it also pledges to support the stable and healthy development of the property sector. The central bank also aims to continue to prevent financial risk and push forward the digital yuan pilot scheme in 2023, it said. So you can see in China a very different path is being cast by the central bank there. It'll be interesting to see how the tussle between those two central banks plays out, and which is going to end up in a better place at the end of the year. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.